Hey traders, Raghee here, and in this free recap video for Tuesday, September 4, when it comes to holidays, I don't know about you guys, but all day long I keep thinking it's Monday, but it's Tuesday, it's a shortened week, but nonetheless, we got a lot going on. And first of all, the first thing that's on my mind, being in Florida, having friends and family in the Gulf Coast, is this hurricane that is heading their way. It's a Cat 1 as far as we know right now, and that means as a hurricane is cutting its way north through the Gulf, there's going to be an effect on crude. Now, I'm going to walk you through a little bit of this, and then we'll have some more discussion on this a little bit later, but I want to talk to you about what we did this morning, and not just the macro, the news, the fundamentals of it, but the technical part of the overbought zone identified by the Darvis levels that I've had my eye on, and which is now for the second time been a spot at which we've shorted. Now, last Thursday, when we were at the lower end of this range, we talked about buying puts. Now, for those of you that are futures traders, remember, part of being a futures trader is understanding the way in which you can handle multiple asset classes, and of course that includes options on futures, and sometimes the options on the futures contract are a really smart way to go. And this is really, I think, ideal for the lower end of a range. Now, this is not a wide range. It's about $1 wide, and the typical price movement range for crude oil is well over $1. Now, that price movement range understanding is a component of the volatility analysis that I do every day for my day trading, for my options trading, for my end of day. Everything that we do at Simpler Futures has a component of understanding what time is it, how does it affect our trade, and the underlying volatility for that day, for that hour. And this is probably as good a time as any to remind everybody, if you haven't already, and I'm going to be demonstrating a lot of this on Thursday, the 6th, at 7 p.m. Central, and that's the ESP. I just love that because I really do feel like when you have this, you have ESP, right? You can read the mind of the market, but it is the exit strategy perfected idea. And the idea is this: put your exits first. Begin your trade entry with your exits in mind, meaning you've got to understand volatility and time, and that's a lot of what we're going to talk about. So this is no exception. This range is understood from the standpoint of volatility. And when we were pushing the upper end of this range with this hurricane bearing down in the Gulf, likely heading towards, say, the Mobile, Alabama area with what could be a significant surge, what we know is that the worst of the storm is probably past most of the rigs at this point. Landfall is coming tonight. So absolutely my thoughts and prayers to the folks up that way at Cat 1. While certainly, and I live in Florida, so gang, I've been through many a hurricane. It's the storm surge that's going to be the issue. Thoughts and prayers to the folks in that area. But the trader in me knows probably the greatest threat to the crude oil disruption, the rigs that have been evacuated, it's done. It's behind us now. So because we held the technical zone here, which I believe is just an overbought zone, because we held, we put puts on in here. So while the rest of the market's rallying, we understand a few things. Where is the storm? When is it going to hit? Is the worst of the fear, the discounting that this could be a much more significant event, is that behind us? And then what's the underlying trade? And so that's where a setup like this is best done with at-the-money puts. And that's a big part of what we did today. Now, what strikes? At-the-money for me in that 71 area. Okay? In that 71 00 area. And so when I go at the money, it's like fading the strength. It's like putting on a short with the crude oil market. But because we know there's the uncertainty of the storm, we take a different asset class that affords us a different kind of protection by way of knowing we can't risk more. We don't have anything any more at risk than whatever we paid for that option. And you don't even have to risk that much. But that's the worst case scenario, what they call the max pain. Okay, so something I want you to think about. How do you put these price movement ranges to work in the futures markets, but in the futures options? Okay, all right, so that's a quick example of a trade that we are looking at right now. I am looking for the market to retrace back to the halfback, the 50% in the 67.70, 67.65 area. That is where I'd likely liquidate most, if not possibly all, the puts that I have right now. And so, again, think about what the catalysts are, how the market's going to discount them, and then how you can position yourself within the technicals and the price level on your chart. And this is now the second time that we've bought puts in this market, last Thursday and again today. So this is going to be a really interesting week. Stay tuned. Lots to talk about. And again, I will most definitely see you all on Thursday. You can register by heading over to simplertrading.co/exits. All right, gang, have a great one. Hope this has been helpful. Think about the way news and price intersect, capitalize on it. I'll see you on the next video.